Did you know that investing in India, one of the fastest growing economies in the world, could be the key to diversifying and strengthening your portfolio? In today's video, we're diving into two of the most talked about ETFs focusing on the Indian market, INDA and EPI. By the end of this video, you'll have all the insights you need to decide which of these ETFs aligns with your long-term investment goals. But why should you care about investing in India? With its booming middle class, rapid technological advancements, and massive infrastructure projects, India offers a wealth of opportunities for savvy investors. Today, we'll explore a detailed comparison of these ETFs, breaking down their differences, performance, and potential to help you make the most informed decision possible. Ready? Let's get started. Investing in emerging markets like India can be incredibly rewarding, but it's not without its challenges. For many investors, the biggest question is, where do I start? With so many options available, choosing the right ETF to gain exposure to India's growth story can feel overwhelming. ETFs like INDA and EPI offer a simple way to invest in the Indian market without the need to directly buy individual stocks. However, each ETF follows a different strategy and focuses on distinct aspects of India's economy. This is where the confusion begins. How do you determine which one fits your investment goals? Think about this. If you pick the wrong ETF, you could end up missing out on crucial opportunities or exposing your portfolio to unnecessary risks. On the other hand, selecting the right fund can position you to benefit from India's long-term growth potential. In this video, we'll break down the key characteristics of INDA and EPI so you can see how they stack up against each other. Whether you're looking for aggressive growth or balanced stability, we'll help you understand which ETF might be the better fit for your strategy. Let's dive deeper to explore what makes these funds unique. Let's start by understanding what INDA and EPI are and how they function as vehicles for investing in India's market. INDA, or the iShares MSCI India ETF, is designed to track the performance of the MSCI India Index. This index represents large and mid-cap companies across various sectors in India, making it a solid choice for those seeking broad exposure to the Indian market. Its portfolio includes well-known names like Reliance Industries and HDFC Bank, companies that are instrumental in driving India's economic growth. On the other hand, EPI, the WisdomTree India Earnings Fund, takes a different approach. It tracks the WisdomTree India Earnings Index, which focuses on profitable companies. This means EPI emphasizes businesses that are not only large but also consistently generate earnings. This focus can lead to a slightly different sector allocation compared to INDA, as we'll discuss in a moment. Both ETFs aim to capture the potential of India's market, but their strategies set them apart. INDA leans toward a market cap-weighted approach, prioritizing the largest players in India. EPI, however, emphasizes companies based on their earnings, which can sometimes result in more exposure to sectors like energy and industrials. Now, let's talk about accessibility. Both ETFs are traded on U.S. stock exchanges, making them convenient options for international investors who want exposure to India without dealing with the complexities of investing directly in foreign markets. Additionally, they both offer the benefits of ETFs, such as diversification, lower expense ratios compared to mutual funds, and ease of trading. But what about their performance? It's not just about what these ETFs hold, it's also about how they've performed over time and what they bring to the table in terms of returns and risk. Each fund has its strengths, depending on your investment goals. In the next section, we'll dive into the historical performance of INDA and EPI, analyzing how they've fared in different market cycles and under various economic conditions. This will give us a clearer picture of which fund might be better suited for your portfolio in the long run. When it comes to evaluating ETFs, past performance is always a key consideration, even though it's not a guarantee of future results. Let's take a closer look at how INDA and EPI have performed historically and what that tells us about their potential. Starting with INDA, this ETF has shown steady growth over the years, closely mirroring the overall performance of the MSCI India Index. Since its focus is on large and mid-cap companies, INDA tends to reflect the broader trends of India's economy. For instance, during periods of economic expansion, such as the post-pandemic recovery, INDA benefited significantly from the strong performance of blue-chip companies like TCS and Infosys. However, its reliance on larger companies also means it's less exposed to high-growth small-cap opportunities. EPI, on the other hand, has a slightly different story. Its earnings-weighted strategy allows it to capture the upside of profitable companies across a broader range of sectors. This approach can lead to higher returns during bullish markets, particularly in sectors like energy or infrastructure, which EPI tends to favor. For example, during the 2021 energy boom, EPI outperformed INDA due to its higher allocation in energy stocks. However, this focus on earnings can also make EPI more sensitive to changes in profitability, especially during economic downturns. For instance, during the COVID-19 pandemic, EPI's exposure to cyclical sectors caused it to experience greater volatility compared to INDA. When comparing annualized returns over the past 5 years, INDA has typically delivered consistent, moderate growth, reflecting its exposure to more stable, established companies. EPI, while more volatile, has outpaced INDA in certain years thanks to its dynamic sector allocation. Now let's talk about risk and volatility. INDA's market cap-weighted strategy often results in lower volatility, making it an attractive option for more conservative investors. On the other hand, EPI's focus on earnings introduces a higher degree of risk, but with the potential for greater rewards. Another factor to consider is the cost-to-return ratio. Both ETFs have relatively low expense ratios compared to mutual funds, but EPI's active weighting strategy can lead to slightly higher costs. Investors need to weigh whether the potential for higher returns justifies the additional expense. In the next section, we'll shift our focus to sector diversification. By analyzing how INDA and EPI allocate their investments across different industries, we can uncover what makes their risk and reward profiles unique. One of the most significant differences between INDA and EPI lies in their sector allocations. Understanding how each ETF diversifies its holdings can help you determine which one aligns better with your investment strategy. Let's start with INDA. This ETF closely mirrors the MSCI India Index, which gives it broad exposure across multiple sectors. However, INDA tends to lean heavily toward financials and information technology. Together, these two sectors account for a significant portion of the fund's holdings. This makes sense, as financial institutions and IT companies are key drivers of India's economy. For example, HDFC Bank and Infosys, two of India's largest and most influential companies, are among INDA's top holdings. This focus on established sectors provides INDA with a level of stability and growth that appeals to long-term investors. On the other hand, EPI offers a more varied sector allocation thanks to its earnings-weighted approach. While it also includes financials and IT, EPI tends to allocate a larger portion of its portfolio to energy, industrials, and materials. This gives it more exposure to cyclical industries that can benefit from India's infrastructure development and global commodity demand. For instance, during periods of high oil prices or increased construction activity, EPI's allocation to energy and industrials can lead to higher returns. This difference in sector weighting creates distinct risk and reward profiles for the two ETFs. INDA's focus on financials and IT makes it more stable during economic slowdowns, as these sectors often demonstrate resilience. However, it also means INDA might miss out on the rapid gains seen in high-growth or cyclical industries. EPI's broader sector exposure, on the other hand, introduces more volatility. Energy and materials, for example, can be highly sensitive to global commodity prices and economic conditions. While this volatility can be risky during downturns, it also provides an opportunity for outsized gains during bullish periods. Another factor to consider is how these sector allocations impact long-term performance. Financials and IT, dominant in INDA, are poised to benefit from India's digital transformation and financial inclusion initiatives. Meanwhile, EPI's allocation to energy and infrastructure aligns with India's ambitious development goals, including massive investments in renewable energy and urbanization. So, which ETF offers better diversification? It depends on your investment goals. If you're looking for stability and exposure to sectors driving India's digital economy, INDA might be the better choice. If you're willing to accept more risk for the potential of higher rewards, EPI's dynamic sector exposure could be more appealing. In our final section, we'll summarize these differences and help you decide which ETF might be the best fit for your long-term investment strategy. Now that we've explored the fundamentals, performance, and sector diversification of INDA and EPI, it's time to answer the big question: which ETF is better for long-term investors? Let's start with INDA. With its market cap-weighted approach, INDA offers a more stable and predictable investment option. Its focus on financials and IT, two of India's most robust and fastest-growing sectors, makes it an attractive choice for investors seeking consistent returns. INDA's lower volatility compared to EPI also means it's better suited for those who prefer a less risky path to wealth creation. For example, if you're building a retirement portfolio or prioritizing capital preservation, INDA's steadier growth might align better with your goals. However, stability isn't everything. For investors with a higher risk tolerance and an appetite for potentially larger gains, EPI presents an intriguing opportunity. Its earnings-weighted strategy and broader sector diversification give it exposure to industries poised to benefit from India's ambitious growth plans. Sectors like energy and industrials, which feature prominently in EPI, could experience substantial upside as India continues to invest in infrastructure and renewable energy projects. One of the key considerations for long-term investors is cost efficiency. Both INDA and EPI have relatively low expense ratios, but EPI's slightly higher fees might deter those who prioritize minimizing costs. That said, the higher expense could be justified if EPI's sector allocations align with an investor's belief in India's long-term industrial and resource-driven growth. It's also worth considering the economic environment. INDA's focus on stable, established companies makes it a reliable choice during periods of market uncertainty or slower economic growth. EPI, by contrast, tends to thrive in bullish markets where cyclical industries perform well. Ultimately, the decision comes down to your individual investment strategy. If your primary goal is to build wealth steadily and minimize volatility, INDA may be the better choice. On the other hand, if you're comfortable with higher risk and want to capitalize on India's growth in energy, infrastructure, and materials, EPI could provide the returns you're looking for. For many investors, a hybrid approach might also be worth considering. Allocating a portion of your portfolio to both ETFs could provide the best of both worlds, the stability of INDA and the growth potential of EPI. As you evaluate these options, remember that investing is a personal journey. The right ETF for you will depend on your risk tolerance, financial goals, and time horizon. In the next and final section, we'll wrap up with actionable steps you can take to implement what you've learned today. As we wrap up today's deep dive into INDA and EPI, let's reflect on what we've covered. These two ETFs offer unique opportunities for investors looking to tap into India's dynamic and rapidly growing economy. INDA provides stability and steady growth, making it ideal for conservative investors or those building a long-term portfolio with a focus on financials and IT. Meanwhile, EPI offers a bolder approach with its emphasis on earnings and exposure to cyclical sectors like energy and materials, which could deliver higher returns for those willing to embrace more risk. Now, it's your turn to take action. If you're considering adding Indian market exposure to your portfolio, start by assessing your investment goals and risk tolerance. Do you value stability and consistency, or are you looking for higher potential returns despite increased volatility? Use this analysis to decide whether INDA, EPI, or perhaps a combination of both fits your strategy. Remember, successful investing isn't about chasing trends, it's about aligning your investments with your long-term financial objectives. If you found this breakdown helpful, be sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss future content. And don't forget to comment below, which of these ETFs do you find more appealing and why? I'd love to hear your thoughts. Thank you for watching, and as always, take control of your financial future, one smart investment at a time. See you in the next video.